Hey folks, welcome back to episode 6 of ICT 2024 mentorship. I hope that you will understand a little bit about the ICT mentorship of 2024. Here I'm going to explain my understanding after watching his long video. Though ICT has explained a lot of things over there, but most of the time he used to give them more advices. So if any of you are interested to listen all of these advices, please go back to his channel and watch his video to all of these advices. I'm not here to repeat those advices. Instead, I'm gonna give you the price action what I have got from that specific video. So welcome guys, welcome back again. Don't forget to give me the thumbs up and don't forget to subscribe to my channel if you're new. Obviously, if you have any doubt, don't also forget to let me know that to the comment box. Here, this is the 7M. But before going there, I really would love to repeat one advice only, and that is if you have some kind of news like CPI, PPI just in front of you, that means today is Monday, so there is PPI in Tuesday and CPI in Wednesday. When you have some kind of that type of news which is really disaster, that type of news are really disaster, in Monday you will try to complete your trade before 9:30. That is the best advice I got from his episode 6. So I thought I should actually share it with you guys. Okay, so if there is any kind of big news like that way, and in Monday you don't have any news, by your calendar you have seen that there is no news around Monday. If you would love to, if you really would love to trade, then you should have been done just before 9:30. Okay, enough chit chat. Let's go to the video. So over here, this is the 7 a.m. kill zone. Okay, that means the 7 a.m. starting. This is the 7 a.m. candle. Around 7 a.m. I am just going to remove this one because you already know this is the 7 a.m. Okay, so keep that in your mind. Around 7 a.m. this candle has created a swing high. That is a high. That is a minor liquidity, which has been taken first. That should be your expectation. That means market is going to take that high as a minor liquidity is going to be taken. If you see there is some kind of relatively equal highs just below before that high, you should also think that market is going to take that highs as well. Don't need to bother about that high. I will talk about this high a little later. You don't need to bother about that one. That means market is going to take that highs and then it is going to make the relatively equal highs. So after taking those highs, market has made that relatively equal highs or smooth highs. This is the high where you should be very much, you should give your all concentration to that smooth highs. After making that smooth highs, what should you think? That market is going to go below to take that relatively equal highs. This low and that low, they are relatively equal highs. Market is going to take that relatively equal highs. In this time frame, what you should think? You should think that what market is actually doing. Now, if you see today's new week opening gap is just here. This is the today's new week opening gap. That means Friday close and Sunday open. So when market is above the new week opening gap and you are exactly over there around that area, what should your first thinking? That market is actually going for that new week opening gap. That should be your bias. Now, when market is falling after making that relatively equal highs, market is going lower and take that relatively equal lows. Should you participate in that price action? No. Why? Because by watching ICT's last episode 1, 2, 3, 4, 5, you already know that you have to wait to take that buy side liquidity that has created after 7. So after 7, the buy side liquidity should be taken. If you are thinking that market is reaching for that new week opening gap, below this new week opening gap, you have that new day opening gap that has been created in Friday. Okay, so in Thursday, actually Thursday 5 p.m. Closing and 6 p.m. opening. So that was that new day opening gap. You should think that market should go for that new week opening gap and new day opening gap by watching all of those previous episodes. But before going over there, market will jagged the relatively equal highs. So over here, this is the relatively equal highs. You should not care about the old highs. So this is the old high before that relatively equal highs. This relatively equal highs, why it is important? Because it has been created after 7. Okay, this part is important. After 7, that relatively equal highs or the smooth highs has been created. Now market has taken that extreme high as well, or the old highs or old buy sell liquidity as the same time it has taken over there. It is good. This is the best opportunity to look for short. Now, ICT didn't tell that. I would love to add this one because I thought he just missed it or he didn't tell it intentionally. I really don't know. But by watching his last episodes, he talked about something before 7. So if he wants to see something before 7, he actually look for London high or London low. When I'm thinking that market is going to take that relatively equal highs and that high is very near that relatively equal highs, this high is actually the London high. Okay, this high has created around 3:50 a.m. New York local time, which is the London session. At the same time, this is also the relatively equal highs. As you can see, this is the smooth highs over there as well. But especially this is the London high. Now I didn't listen or ICT maybe didn't talk about this. This was the London high. So I will think that market is going to take that London high as well. But as per ICT told, you don't need to bother about that high. Instead, you should focus on these relatively equal highs only. After taking that relatively equal highs, what should you think? Now, when these lows are taken over there, this is going to be your minor sell side liquidity. Then this low and that low, this low, finally that low, and this new week opening gap below this new week opening gap until this new day opening gap. You should look for sell. When market will reach over there, you are done for the day. Why? Tomorrow we have a very important news. The day after tomorrow we have CPI. So those time frame or those news are really monster. So when you have those type of news just in front of you and you are in Monday where there is no news at all, you should not be participating in this price action because every single one will try to do something after 9:30. They will try to take buy, sell, whatever. They will keep trying to do that. But here you should not participate in that, competition of losing trade. So let me explain this thing now. After taking these relatively equal highs, where market has taken that relatively equal highs, I would love to explain this order block first. This is the highest up close body close candle which has taken that relatively equal highs at the same time this old highs or the London highs. Okay, so this is the highest up close body close candle. Look at this open. When the body has closed below that open, I repeat, when the body has closed below that open, not that low, below that open, and then the very next candle open below that line, below that open line, and then trade toward that order block, that up close body close candle, it is going to use as your change in state of delivery. You will push your button over there and you will keep thinking that market is going to take that minus sell side liquidity at least. Obviously this sell side liquidity should be very important because by the last episode this is a very strong support and resistance zone, so you can get a lot of reaction from there. So as you can see, market actually came here then come back again over there. Okay, so something like that. So this is very important. You have to take the partial to that line until the end of this day. This line and that line, they are extremely important because this is your real support and resistance zone or the line. So this is the change in state of delivery. In other words, this is the order block, which is the most important part of this order block, the low to the open and the 50% of that up close body close candle. Here ICT also talked about something that is very special, and that is your stop loss. Where you are going to put your stop loss above that candle? No, he is going to put his stop loss just above the mean threshold, just above the mean threshold. That means the 50% of that up close body close candle. Why? Because if you are wrong, then you will be stopped out to the mean threshold. Market should not go above the mean threshold. This is the thinking of here, because market has already taken that smooth highs which has created after 7, and then it has taken the highs, old highs as well. After taking that, market has made that change in state of delivery. That means market should not go above that mid threshold of that order block, that bearish order block. So you should be thinking that your stop loss is set just above the mid threshold. Then market fall, and this is the fair value gap. Look over here, this volume balance high, this volume balance low. This is your bearish fair value gap. Market tap to this bearish fair value gap, fall again. When market fall again, look, this is the highest up close body close candle with this fair value gap. Now when market reach until that area, then market went higher again. Okay, when it is going higher and tap to the low of this fair value gap, you should be in the market again, because you should not be scared about taking sell. Market, where market should go to take this minor sell side liquidity, or this line. Look at this line, at least until that area market should reach, and you can see that market reach until that area, then it has been reversed. It is not reversing from that line, dotted line. This is your initial sell side liquidity that is going to be very important at the end of the today. So market when came here, what else do you see? This up close body close candle, which is the change in state of delivery, mark the low, or sorry, the open of that candle. Okay, here mark it and extend it to your right. This is your order block. When price came here, tap to this opening if you even don't want to push your button from that bearish fair value gap. Now, why that bearish fair value gap? If you have already watched other episode, you already know that when the market has already decided to go and fall for the liquidity, sell side liquidity, every bearish fair value gap you will mark and you will extend it to the right. You will mark that fair value gap, you will extend it to your right. Okay, now over here, when it tapped to this bearish fair value gap, it doesn't matter how long it takes to reach until this area or that specific order block. You should not care about that. You know that market is going to fall how long? Until this new week opening gap. If it is overzealous, then it can reach until this new day opening gap as well. So you should be biased, or you should be stubborn to look for sell only. Here, this is the area where if you miss that order block entry, maybe you have missed that entry as well. So you are going to push your button either from the low of this fair value gap or to that specific order block. You will put it over there. Where is going to be your stop loss? Are you going to put your stop loss maybe just above this one? No, you are not going to do that, because you have this fair value gap over there. This is the fair value gap. You have to be very careful of that fair value gap, because market can retrade that fair value gap. So your stop loss has to be above this fair value gap. Now over here, as you can see, this is the whole price action over around that area, and in this type of situation you have this inversion fair value gap as well. If you mark that inversion fair value gap and extend it to your right, you will get more precision from there as well. Now, I'm not interested to mark that inversion fair value gap over there, as ICT didn't do that. I am only interested to deliver the price action what ICT has delivered. Okay, so over here, when market has traded that things and market went lower, take that minor sell side liquidity. This sell side liquidity has taken these lows. Okay, like these lows has been taken over here. These lows has taken over here. This is the minor sell side liquidity. Why these lows are important? Because these lows has created after 8. Just look at the candle. This is the 8 candle. Okay, so around 8, just after 8, this is the relatively equal lows. Market didn't take that relatively equal lows over there. So later market came here, take that relatively equal lows. After taking that, I mean, when market has taken this relatively equal lows, this is going to be your minor sell side liquidity. Market has already taken the relatively equal highs, which has created after 7, because when you were here after 7, you are 8 or after 9 or wherever you were, you know that you can use the price until 7 a.m. So before 7 a.m. price action, you don't need to care, but until 7 a.m. you will be able to use the relatively equal highs or relatively equal lows. So here, when market has taken this relatively equal lows and made that new low, this is going to be your minor sell side liquidity. What is the importance of that minor sell side liquidity? Then you saw market reach until that area, come back again, went below this minor sell side liquidity. You should take a partial over there, and you should keep thinking that market is reaching for that minor sell side liquidity. And as you can see, market finally came here, and then it has taken this minor sell side liquidity. This is after this is the 9:30 open. So because of the volatility around 9:30, market go back again until this bearish fair value gap. So from episode 2 or 1, I don't remember, you already know, sorry, episode number 1 actually. So you ICT already, I mean, strictly told that until you are bearish, every single bearish fair value gap you will mark and you will extend them to your right, because they are going to be traded again and again. Okay, so here it has been traded that fair value gap. Look the bodies, how beautifully it has closed inside this fair value gap. After trading that, the market fall that was a dramatical fall over there. It has went through this new week opening gap. Finally, it came to this new opening gap, trade that new opening gap, went little higher, trade the new week opening gap low. This is the new, this week, new week opening gap, okay? Trade that one, then fall again below this low, take that liquidity, then perfectly market went higher. You should not care about that buy or these things because you should be done around that area. You are done. You are reading the price action from the 7 a.m. and you are seeing what is happening over there. When this buy side liquidity or smooth highs has been jacked over there, you and every PDRA is over there. Nobody is going to hide that from you. So you are using those PDRA to think that how market is going to fall. At the same time, around 9:30, obviously you can use the opening gap the way ICT has explained the opening gap yesterday's. Not yesterday's, in episode 5. You will find that to my YouTube channel. If you want to watch them, you can obviously watch them. But obviously, you should care about the minor sell side liquidity, how to mark those minor sell side liquidity and initial sell side liquidity, initial buy side liquidity. They are extremely important. And obviously, you have to understand where market is reaching for. If there is a new opening gap that is open just below you, you should simply think that market is reaching for that new opening gap. For that, you have to wait to see that the buy side liquidity is jacked. Okay, when it is jacked, then you are good to go for the sell. By the way, as you can see that this new week opening gap, I just didn't mark the constant encroachment or the quadrant level because this new week opening gap is just for how many? 12 handles, just 12 handles. So below 20 handles, if there is a new day opening gap or new week opening gap, I'm just not interested to mark the constant encroachment or the quadrant level as per ICT. Okay, ICT told that. It's not my opinion, it's ICT's opinion. If it is below than 20 handle the gap, then you don't need to mark them. So over here, this is absolutely time is the factor. The time you are using from 7 to 8, 8 to 9, 9 to 10. So this is the time frame where you will be able to find out this type of setup every single day. Okay, so guys, that was the theme I got from ICT's episode 6. I know that if you're not impressed enough, I don't know what to say, but this is all I got from episode 6, how to use the setup and how to build more confidence to trade by this model. So if it is useful to you, don't forget to subscribe to my channel and don't forget to give me a thumbs up. So until the next video, cheers.